For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
This is right. Thank you. Thank you very much. Happy to be here. It's Managing Your Financial Future. Podcast host Johnny Dean, Professor Rick Plum, certified financial planner professional and accredited wealth management advisor. Quintennial podcasts. This is what I'm told. Rick Plum, you brought up a word that never comes up outside of spelling bees. 250 episodes. Is that really what this is?
Well, I think that means actually 250 years, but
well, yes, it does. But
I'm saying we're episode, and some people may think it feels like a year goes by every time they listen to one.
Oh, don't shortchange yourself. Speaking of like a year's worth, we got like a year's worth of stuff to get in on this particular episode here. So, but before I get into what the actual topic is, I should mention this because we had got an email from somebody back in, I think it was like December. So I apologize for not bringing this up beforehand. It was, Dale in Michigan. And he mentioned that something we had said about Irma back starting after the Obamacare. It had actually started before that. And I think we had, I don't know if it was incorrect information, but he certainly wanted to clarify it for us. So I thank you for that. Always good when we have alert listeners on this particular podcast. But I thought I'd mention it as well because he mentioned he still remembers our jingle from the old show.
Which I didn't remember.
Your money, your business, your life. We had this great jingle and a music playing and all this stuff at the start. This was back in the old radio days. And so he just happened to mention that. So Dale, thank you very much. And we thank you for that is a really long-term listener. So that's wonderful. All right, let's get on to the topic at hand for today. We've talked in the past similar things. Most recently, we did the Save Like a Pessimist, Invest Like an Optimist. We talked about best way to win is to keep from losing. And this is a point that I think needs to be hammered home quite a bit. And this topic today, I was kind of inspired by both an email that we got and by a study that somebody had sent me that relates directly to what I'm going to talk about here. Rick, have you ever heard of the marshmallow test?
No, other than throwing them and tasting them. That's all I've ever really had to deal with marshmallows.
Well, marshmallows are a wonderful, wonderful thing. But this was a series of psychological studies done back in the late 60s and 1970s. It was at Stanford University, and it was designed to measure a child's ability to delay gratification. So in this experiment back then, a young child was left alone in a room with a single treat, usually a marshmallow, sometimes a cookie, whatever. And the kid was given a choice. They said, okay, you could eat the treat right now, immediately, or you can wait for the researcher to return, which is about 15 minutes, and you get a second treat. So you get double, right? So, of course, these psychologists and their team, they're kind of observing the kid's behavior through this one-way mirror. Some of the kids, of course, ate the marshmallow right away, bird in the hand or treat in the hand, whatever. But the kids who waited used these various coping strategies to resist temptation. Like they would sing and they'd talk to themselves. They'd walk around, cover their eyes, whatever they had to do to make the 15 minutes go by more quickly. Now, they kind of suggested that there was a correlation between having the ability to wait as a preschooler and positive outcomes later in life. Now, I don't know about that. Who knows? But what I found reading this, and my takeaway from that was that the lesson in this particular thing was it wasn't all about patience, Rick. It was more about short-term management. The kids who waited were not, I don't think they were stronger or more disciplined. I just think they succeeded because they found ways to manage the discomfort of the short term. Distract yourself, you reduce temptation, you make the waiting tolerable. And the long-term reward in this case only existed because the short-term did not overwhelm them. I think you know where I'm going with this. If we're going to relate this to finance and our listeners...
some long arms there, buddy. That's a good stretch.
Well, no. But listen,
I get it. I see where you're going.
Right. So I mean, if you're thinking about this in terms of financial plans, maybe you would agree with this statement that I came away from this was that many, if not most, financial plans fail for short-term reasons and not long-term ones. Would you agree with that?
I do. I very much agree. And that's where controlling, as the marshmallow issue, controlling that initial emotional reaction to something. In the marshmallow thing, it was controlling the initial desire for a sweet. With investing, it's controlling the initial emotional desire to sell something just to keep from going to zero. Because I'm afraid of the market, it's going to go away. But it's all about controlling that initial emotional reaction to something. Yeah. And that's what we have to deal with. Because as you've said many times, other than taxes, and in many cases, individuals' emotional behavior towards their investment portfolio is the biggest detriment to their portfolio. Taxes are a problem, but they're not as big as how badly you can screw it up.
Well, this is absolutely true, and this is the whole reason behind buckets, really, because anybody's financial plan. I mean, buckets contains. If you have a bucket strategy, you've got the stocks portion of it, which just about everybody's portfolio does. You've got a bond portion of it like that. But I think what many financial plans miss, who do not do buckets, are missing the most important element of this, which is the bucket one. I don't know if you would agree with that, but you probably would.
Well, if you set up your buckets today, and then you looked at it as one big pie chart, you have a balanced portfolio. But the difference is in how you treat the individual investments within that overall portfolio. You don't treat them all the same. You don't take the distribution from across the board pro rata, which you do in a systematic balanced portfolio distribution method, which is, by the way, wrong. Don't do that. But it looks, if you looked at it as a big, all in one piece, it looks like a balanced portfolio. But how you treat the individual pieces, the individual buckets, shall we call it, is the issue that helps you withstand the downturns. It helps you emotionally understand what's going on, emotionally be a more sophisticated investor, less reactionary. It helps you control your emotions, and that's a positive issue.
Well, and some criticisms, I think, I don't know if they're criticisms, maybe they are, observations from people who ask about this. If somebody's got $1 million portfolio, let's say, oftentimes, Rick, you will design a bucket one that will last 7-8 years, something like that, right?
7 years is the traditional.
Yeah, okay, 7 years. And in that bucket one, you're carving off a good chunk of money, maybe a third, usually.
Give or take. I mean, let's just take, if you wanted $50,000, you would put 7 years worth of $50,000 distributions, ignoring time value of money and the fact that you can earn some interest on it. 7 times 5 times 50, is 350. Put 350,000 in bucket number one. Now, if you're taking a $50,000 distribution, you're probably going to have, assuming we're taking a straight distribution, we're not going to reduce it in the future because of this, you probably got $1 million+ portfolio. So you're taking a 4 or 5% distribution. It ends up being about a third.
Yeah, and then so that's 7 years, and then another 7 to 8 years of,
and then we do the same thing for another block of years. Typically, we do 8 years for that second block, and what happens is, and we were talking about this in a training course that I was dealing with yesterday with some younger advisors. Buckets 1 and 2 become very similar to each other. We were putting $350,000 in bucket number one, $350,000 in bucket number two. The difference is bucket number one is going to start distributing money right away. Bucket number two is not going to distribute anything for 7 years. That's what bucket number one's for. And so you can get a little bit better rate of return. You don't have to be as liquid. You don't have to be as super safe, no volatility. So you can put it away and earn a little bit better rate of return. But towards the end of the first 7 years, you're going to change the character of that bucket number two, into a new bucket number one. And then pay that out. But not just pay out $50,000. You're going to pay out an inflation-adjusted amount for the next 8 years. And what happens then is you've built the first 7 years, the second 8 years, taking almost no risk in either one. So you've built a 15-year time horizon for that long-term growth bucket where the volatility does live because it's a stock market-run portfolio. And volatility is just a daily occurrence in the stock market. Over time, it tends to be a positive volatility. Short time, it can be very negative. I mean, we were talking the other day with some wonderful friends. You remember how long it took the NASDAQ to recover after the tech bust in 2000?
Well, let's see. It supposedly
to get
bottomed
back
out.
to even, the NASDAQ went down 78% in 2000 to 2002. It didn't get back to even to where it was in the beginning of 2002 for 15 years.
Back to even.
Now, where did I hear this 15-year thing before? What's 15 years? Is 7 plus 8 is 15. It just kind of comes hand in hand. You're looking at this S&P 500. How long did it take to get back to even after the tech bust? 10 years. So we want that long-term time horizon, not because we're afraid of the market, but because I can't choose when the top of the market or the bottom of the market is. And while I don't believe that we're going to have that kind of crash tomorrow, well, I guess it could happen, but I don't think it's going to happen. We protect against it just in case. But reality also dictates that if the market does what it's done for the last 3 years, 23, 24, 25, 18, 20%, big years. Let's take some cream off the top. So this is how management actually happens, not just set it and forget it, not don't worry about it. The markets always do this or that. Let's put this into an area that we have at least some semblance of control, and take the volatility and try to find positive volatility while we're protecting against that negative volatility, but don't use that volatility at all for the cash flow that I need in the what we call short term, 7, 8, 10 years.
It's a lot of it is based on discipline, and but the idea, of course, is to buy time. Now, you mentioned
time is everything when this comes about.
Well, it is, and you mentioned markets. 23 was up a lot, whatever it was, 18, I don't know, percent, a good amount, far
close
more
to
than
20%, either above, slightly above, slightly below the last 3 years.
Yeah, so 23, 24, and 25. That's kind of what we were looking at. Now, somebody might look at that and say, "Okay, wait a minute. Now that's a pretty darn good return." Now, you took my $1 million, this hypothetical million that we were talking about. You carved off, 350,000 of it, 35%. And you put it in something that's not earning a whole lot. Then you took another, call it 350,000, another 35% of it, and you put it into something that's certainly less than what the market was delivering, which only left, maybe $300,000 to sit in the market and create those big returns. Now, this is, I said there was some criticism. It's an observation, but let me put that in context, if I may, Rick, okay? Because this is where the email from somebody got me thinking about this as well, and why I wanted to talk about it. We had an email from Harry, I'm not sure, in Niagara Falls, New York. And this was after our episode in January about Save Like a Pessimist, Invest Like an Optimist. And he put it very well. He says, where is it on the bottom here? Scroll down. Here we go. He said, people have asked me if I've figured out how much long-term return I'm giving up by holding 30% of my portfolio in lower return assets in bucket one. I tell them that I have calculated that, but I've also done the calculations on how much I'd lose if I were forced to sell stocks during a downturn for an emergency or any other reason. As it turns out, he says, that is far costlier than the return I'm giving up on my bucket number one. I mean,
exactly.
That says it all.
That's perfect. And it has to do with risk return and what are you more comfortable with. Now, if you don't want to manage the risk on the downside, you can take the gamble and say, I don't want 15 years. I want 5 years. Okay, fine. You have a much higher probability of outperforming than I do, but you also have a significantly higher probability of running out of money than I do. Well, and if you're willing to accept that, that's your game.
But then we get into the whole idea of gambling, and that's kind of what this is. I've found that, companies, by the way, companies do this too, okay? And there's a good quote I found from Bill Gates. This was years ago, like his early days as CEO of Microsoft. The quote said, Bill Gates said, I came up with this incredibly conservative approach that I wanted to have enough money in the bank to pay a year's worth of payroll, even if we had absolutely no payments coming in. He says, I've been almost true to that the whole time. Now, think about that. I mean, for him and for this company, that's like a bucket one in many ways, you know? What he's doing in this sense is managing the short term, making sure that he doesn't ignore the short term in a kind of bucket one. And if you look around...
And he doesn't need 15 years because he's got a whole different metrics of risk and things that he's dealing with.
Well, he does. But, early on, he didn't know. I mean, he had a pretty good idea of what it could be, but you just don't know. And if you look at companies like, there are other companies, Apple, Google, companies like that, they hold hundreds of billions in dollars in cash that only earn a small return. But by doing so, they have the flexibility and the endurance to earn much higher long-term returns on other assets. So they don't have to do this.
I think part of that was the problem with the tech bust back in the day, too, because those companies didn't have enough cash to make their bills for the next 6 months. And they had no chance of making a profit in the next 6 months. And wow, did that last for long?
I'm telling you. I found one more quote, and I don't know who said this, and I apologize, but the quote was this, and I think I've said this before on previous shows. The only reason the long term works is because the short term is so protected. There is a graveyard of investors and companies who were fully invested in the honorable name of long-term thinking, but learned the hard way that their I'm not focused on the short-run attitude has its costs. And I read that, and I thought, man, I mean, that's absolutely true. We're not going to worry about the short term. We'll just look at the long term. But by ignoring the short term, you're running an incredible risk there. It's kind of what you just said. You can go 5 years on a bucket one. But there's a gamble there.
Your call. It introduces more variability in outcome. And it could be a positive outcome or it could be a negative outcome. But the shorter you go, the more likely that negative outcome becomes, unfortunately, a reality.
Yeah. When I was talking about the marshmallow study a bit, and I kind of said it's not really so much about patience. Here's one that I've done a lot of research on this because I found this fascinating. A quote that says, patience is often described as the most important investing skill, but patience alone doesn't help if someone's under financial pressure. And so I guess, Rick, if you're designing a plan for somebody, specifically a buckets plan, is removing this financial pressure sometimes more important than just trying to be disciplined?
Well, it's a way to create that discipline. It's a way to help with that discipline. By its very nature, that's one of the things we're trying to accomplish. It's taking that emotional aspect out of it, which helps us be more disciplined in the way we're dealing with the investments.
Well, you could tell somebody over and over, and you can say, just, hang on. Yeah, we're in a downturn now, or whatever it was. I mean, think of somebody in 2007 it seemed like the world was ending. And you could have told them and said, just be patient. I'm sure it'll come back, and it will over time. But for somebody who's got to pay their bills tomorrow and is looking at all I've got is long-term money, I mean,
well, those are the people we were talking to so much because the people we were talking to had their buckets in place and had the staying power, had the time horizon available. And it was a matter of, you can wait this out. You've got plenty of cash on the sideline or cash flow available, whether it was them working or it was the money that they have invested appropriately. Don't worry about it. You don't have to sell it tomorrow because it's not going to go to zero. And reality is, if it does go to zero, none of this matters. B, you've got time for it to recover. And, actually it hit the bottom not too, long after it started down. It was a very steep slope down, but October was of 08 was the big, impetus, the cliff basically, and March of 09 was the bottom. So 6 months. And then it started to recover. But people didn't believe it was going to recover. People like, this is just a false bottom. It's going to go down again. It's like, come on, just live with it. You've got it made. You don't have to sell when it's down. You don't have to shoot yourself in the foot.
Yeah, and what you did, though, for those people that you're talking about with the bucket strategy was you actually removed that financial pressure. And by that I mean you say, okay, you've got the cash flow, okay? You've got short-term financial needs, but we've got those taken care of with the cash flow that we've set up inside this particular bucket strategy. So if you can remove that financial pressure, it's, as you said, you don't have to tell somebody to be disciplined because they just naturally will be. Have you seen that? I know you've seen that.
It's a byproduct, but it's an intended byproduct. The bucket's cash flow strategy, the time segment strategy, is there to build that discipline, to remind people that they don't have to sell, even when they think they want to. It's part and parcel to the entire design of the program. It's there to avoid the downturns, but it's also there to help you not sell during the downturns.
We talk a lot about downturns, which is the reason for buckets. But of course, you have, come back to the last 3 years that we've had, and this is early 26 when we're recording this. So, but 23, 24, 25. When somebody's looking at the S&P going up at a certain amount and saying, man, what I'm getting at here is there has to be discipline on the upside as well, Rick. When the markets are going up, it can be sometimes a challenge to remind people why you're being a little bit more conservative on the bucket strategy. When they say, "Oh man, I could be doing look what the market's doing. Shouldn't I be all in?"
Yeah, we get that question a lot though. Is now a good time? Should I be all in? Because the market's been on fire. I don't want to miss out. I was like, well, you've already missed out. Let's see what we're trying to accomplish with this money more than anything else. If you've got that 15-year time horizon, sure, now's a good time to get in. If you've got a 15-week time horizon, no, it's not a good time to get in. The answer hasn't changed in 30 years that I've been doing this. Is now a good time to get in? It's just the way it is because we cannot predict when the high point is going to be. When should I get out is that question. And the other side is, when should I get in? Was there anybody really calling for everybody to get out in early March of 2000? No, they were all calling to get in. Was there anybody trying to tell you to get back in was it March of 2009? No, that was when you have to kind of just either be a clairvoyant, not happening, or have a discipline that doesn't require you being a clairvoyant.
Would you say that bucket one is probably the most important bucket of the 3 or 4 or 5 that you have? I'm going to tell you why I think it is. I'll just tell you because, buckets 2 and 3, of course, and they're all important. But if you take bucket 1 away, you've lost the whole advantage of, let's say, potential advantage of doing a bucket strategy. But what's your thought on that?
Well, it's integral. I mean, why would you, assuming that you are looking to have a investment cash flow starting in the not too distant future, you can't get away from bucket number 1 if you are looking to have cash flow from your portfolio starting this year, next year, the following year, something like that. You don't need bucket number 1 if you're 25, you're not going to retire for 35, 40, 50 years. You are bucket number 1, by the way. You're the asset that's creating the income to make your bills. But that's why we talk about emergency funds or having emergency cash and things of that nature, because there's always unknowns. But as far as somebody who's retired or they've hit the point where they're needing their portfolio to make a payout, whether it be education for college or something of that nature, not having a bucket number 1 just shoots everything to hell. I mean, it's integral. You have to have it. Otherwise, you don't have a bucket plan. You just have a more aggressive balanced portfolio.
Yeah, and what that means is you're taking care of the short term. It goes back to what the whole topic is for this particular episode, which is that taking care of the short term is the important part of this so that you can allow the long term to do what the long term has always done, at least historically. And so that's why when I say bucket number 1, while they're all important and you need them all, without bucket 1, the whole thing falls apart.
Right. You could, I mean, if you have enough money, and you could do without bucket number 3. I mean, you don't have to have bucket number 3. As you get into your 80s and 90s or later, bucket number 3 is for that money you don't need to spend 15 years from now. I mean, I get a lot of people in their 70s saying, I'm not going to be here in 15 years. Yeah, but what if you are? I've never had anybody in their hundreds say, I'm not going to be here in 15 years. And I'm going to argue with them. I'm sorry. It just doesn't happen that way. But while the older you get, the more in stocks you could technically have and accept that risk. You don't have to have bucket number 3 because you don't have to provide that 15 years worth of money if you're 90 plus years old already. But if you're 65, there's a chance, and it's probably a very good chance, that you're going to live more than 15 years. I hope so.
Well, as you said, especially the older that you get, the less that longer-term bucket, I don't want to say matters, but yeah, I guess the less importance it probably carries. I'm sure if somebody who was 85 came to you and they just said, I really don't want stocks anymore. I just, for whatever reason, I just don't want it. So give me, put me all in something that's safe or, guaranteed or non-volatile, and I'll just.
Oh, by the way, I want a 10-year. I want a 10%. Excuse me. I want a 10% payout. I got $1 million. I want $100,000 a year. Okay. We just want to have a bucket number 3.
Well, but it can work. But I just.
Not at 65 so much, but at 80, 85, yeah.
Yeah, well, it's not a gamble. Now, somebody who's 65 and has potentially 30 years to go, I mean, if you didn't have a bucket 3, you run some risk, I guess, of what? There's inflation risk there. There's what sort of risks does somebody have if they're 65?
There's the risk that you become the oldest living American in the world. Or oldest living human in the world, American. Don't worry about that. That's the risk. The risk is that you outlive your money. You live to be 96, and you only provided till 95.
Well, that's true. So I think it's important to talk about things like this. And I'd like to reiterate this from time to time, because especially as the markets have been going up and people start to say, man, I think maybe it's time. People forget. They just forget. They say, I want to jump in the markets. I want to get into these various, I don't want to mention them, but speculative ventures. They see all this money being made potentially, but again, that's taking long-term money and putting it into the short term, and I think that's what we call gambling, and I'm sure you would agree.
You can get rid of bucket 3, but you cannot get rid of bucket number 1.
Yeah, which makes it, I say, the most important bucket. These are the kinds of things that I think people really do need to think about, because a lot of times plans don't fall apart because the long-term math was necessarily wrong. I think more often they fall apart because the short-term got uncomfortable for them and they didn't have anything to back it up. The market dropped, pressure was too much, and so that's why managing the short-term matters so much. I think if your plan cannot carry you through these short-term moments, and that's what the long-term is. Long-term is just a collection of short-terms, one after the other, But if you can't get through those moments, the long-term reward never really has a chance to show up. And by the way, these are the kinds of conversations that the advisors at Lucia Capital Group that have with their clients every single day. You've heard Rick talk about people who didn't care about what happened in 2007 to 2009, only because they had their income needs, cash flow needs covered, and that's what the bucket 1 was. If you aren't bucketized yet, or you haven't done anything like this, you should have a talk with one of the Lucia Capital Group advisors. We could talk about your cash flow, your overall strategy, your income plan, whatever it is. It's make sure it's built to handle real life. You can give them a call, 800-644-1150. 800-644-1150. Professor Rick Plum heads up the financial planning department, and the team works together, reviewing plans and strategies, making sure all the pieces fit together the way they should. This stuff can get complicated, but the Lucia Capital Group advisors are there to help you out. Don't forget, you can also visit luciacap.com, LUCIACAP.com. Find information on everything that we talk about here, along with there's a whole library of free downloadable guides. We'll have to update the Social Security guide for 2026. We'll do that. But there's retirement income, as I said, Social Security, tax strategies, estate planning, bucket strategy. It's all up there. Just type in what you're looking for into the search bar. You can download the guide and take your time going through it. I think you'll be glad you did. As always, make sure you subscribe to the podcast, Apple Podcast or Spotify. Do not miss an episode. This is a direct order from me. All right? There will be a quiz. We're out of time. We are. My thanks, as always, to Professor Rick Plum, certified financial planner professional and accredited wealth management advisor. I'm your podcast host, Johnny Dean. This is Managing Your Financial Future. Thanks so much for listening. We will talk with you all again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risk associated with an investment in the shares are compatible with their investment objectives. Examples cited are hypothetical, are for illustrated purposes only, are not guaranteed and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Stock investing includes risks including fluctuating prices and loss of principal. Bonds are subject to market and interest rate risk. If sold prior to maturity, bond values will decline as interest rates rise. Bonds are subject to availability, change in price, call features, and credit risk. The NASDAQ Composite Index measures all NASDAQ domestic and non-U.S. based common stocks listed on the NASDAQ stock market. The market value, the last sale price multiplied by total shares outstanding, is calculated throughout the trading day and is related to the total value of the index. Indexes are unmanaged and cannot be invested in directly. The S&P 500 is a stock market index tracking the stock performance of 500 of the largest companies listed on stock exchanges in the United States. Indexes are unmanaged and cannot be invested in directly. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at sa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. Any other individual or company mentioned in this podcast are not affiliated with or endorsed by Lucia Capital Group or LPL Financial.